Okay, so this is a quick video to go over the midterm, just so, since it's obviously you can't come to my office to see what you did. If you have a more specific question after this, email me and we'll try to see if we can answer it. All right, so the first question was a medical expense question. Cindy fell on the ice. Basically, that one, all the expenses were qualifying expenses except for the over-the-counter medication. So you add up the other ones other than that, and then you have to subtract 7.5% of her AGI, and you should have got 1,600. All right, the total expenses were 4,000, but then you subtract the AGI floor to get 1,600. Number two, Carlos donated common stock in Deere Inc., right, John Deere, and the market value was 60,000. His basis was 20,000. He's held it long-term, and he gave it to a qualified charity. So the answer here is basically, right, his deduction amount is the fair market value, right? But because it's capital gain property, he's limited this year to 30% of his AGI, which would be 30,000. Number three, if Eduardo filed for and received an automatic 6-month extension to file his tax return, he must pay his full tax liability by October 15th in order to avoid a late payment penalty. That's false. He still has to pay by April 15th to avoid the late payment penalty. Right? He just doesn't have to file until October 15th. So he'll avoid the late filing penalties, which are usually higher, but he still has to pay. For the lifetime learning credit can be used towards the cost of instruction to acquire or improve a taxpayer's job skills, no matter the age of the taxpayer. That one we were looking for true. Number five, in 2019, Deidre and Dave are married. Their AGI is 129,000. So they have interest on acquisition debt for their home. That's going to be deductible. Interest on their second home, right? And together, right, their total principal is still under the maximum limit, so they can deduct all of that interest. They can't deduct interest on their personal car loan, and then they have student loans, right? So they're not phased out on their student loans. Their AGI is low enough for a married couple, but the most student loans interest you can deduct in 1 year is 2,500. So it's going to be all of the mortgage interest and then 2,500 of the student loans. So they'll get 25,500. Edmund and Janie have income tax liability of $50. They have $3,000 of withholdings, and they have an earned income credit of 4,000. All right, so the question's asking what's their refund, right? Well, so the credit is going to eliminate their liability of $50, so there'll be $3,950 left, and they'll also get their, and that's fully refundable. Then they'll also get their withholdings back. They're going to get $6,950, right? We're basically taking $50 minus the credit. The rest of the credit is refunded plus the withholdings, $6,950. Greg is self-employed. He went to a convention directly related to his business, right? And it was, right, he spent the majority of the days on business. So this is going to be a primarily business trip. Since it's primarily business, domestic trip, he can deduct all of the airfare, $1,400. He can deduct his lodging for the 3 business days, so 150 times 3. He can deduct his solo meals on the business days, so 120 times 3, then we'll take half of that, right? So his meals on the business days divided by 2, and then half of his meal dinner with the client as well. So he should get, I think that comes to, which one of these? All right, so we're going to take the 70, half of this meal, 120 times 3 divided by 2 should get us 180, plus the lodging for the business days, plus the airfare, and we should get 2,100. Cheryl's AGI is 140,000. Her current tax liability is 22,100. And last year, her tax liability is 20,922. Right, so this one is looking for what's the safe harbor that she needs to prepay to avoid prepayment underpayment penalties. All right, so since her AGI is less than 150,000, she could either pay 100% of last year's liability, 20,922, or this year's liability times 90%. So that would be 19,890. Right, she takes the lower of the two. That one's lower, that's all she has to prepay. Number 9, right, hopefully this was really easy as an open book question. Individual proprietors use Schedule C to report their business income and deductions. We saw that one a couple times in class. Number 10, Kaylin takes her 4-year-old twins to trustworthy daycare so that she can work. She paid the daycare $6,300 for the year. What's her child independent care credit if her AGI for the year is 36,000? So that her applicable credit percentage is 24%, right? So it just tells us the percentage from the table, right? This is what she actually paid. But for 2 or more kids, the most she could deduct would be 6,000. So times the 24% that we're given, 1,440 would be her deduction. Campbell is a single taxpayer. She has net profits of $400,000 from her store, where she's a sole proprietor. She has employee wages, qualified property, and taxable income before QBI. So we want to find her deduction for qualified business income. I think this question probably appeared later when you were taking it on Blackboard. It got a little, the order was slightly different. So on this one, she's not a professional service, right? Specified service business. She's just running a store. So she's not going to be subject to the phase out for that, right? But she is high enough that she would be subject to the other limits, right? Based on W-2 wages and qualified property. So her, right, and her QBI, right, her business income is less than her taxable income. So this one was just looking for 400,000 times 20%, right, or 80,000. And that's going to be right. She's going to be limited also to 50% of wages, though, right? So 50% of that obviously is 50,000, right? So since her income is high enough, she's subject to that limit. 50,000 would be the answer here, right? And that's what we're right. The other limit is 1/4 of wages plus 2.5% of property, but that's 26,000. She can take the bigger of those two numbers. Number 12, Celsa has 3 children, Denise, Hector, and Priscilla, right? And gives us their ages. It's asking for her, how many credits can she claim from her children, right? So the issue here is, right, you have to be younger than 17 at the end of the year to get the child tax credit of $2,000. So only Hector and Priscilla qualify for that one. And Denise can get the $500 other dependent credit. So 2 plus 2,000 plus 500 should get 4,500. Jeremy and Andrea are married filing jointly. Right, it tells us, right, they have 100,000 of taxable income, which includes a long-term capital gain and qualified dividends. So it tells us already what their liability is on their ordinary income. So we basically just have to figure out the tax on the long-term capital gain and the qualified dividends. Right, we could just look at if we looked at the, I think I have it on here. Right, if we look here with their 92,000 of ordinary income, they're going to be in this range. So their rate on long-term capital gains and qualified dividends will be 15%. Right, so they had 8,000 total times 15%. Right, so then we're going to add their liability on their other income, which we've been told. All right, so they should get 13,157 is their total tax liability. Clyde operates a sole proprietorship. He's on the cash method. He paid $600 for 12 months of property insurance beginning on July 1st, 2019. All right, so how much can he deduct for 2019? He's the cash method, and so this is going to be the 12-month rule. So since he's paying for something, it's not interest, and he's going to get the benefit, right? It lasts for 12 months or less, and it doesn't go beyond the end of the next tax year. He can deduct all 600 in 2019. Ahmed operates a catering service on the accrual method. In November, he received payment of $9,000 for 18 months of services to be rendered from December 1st, 2019 through May 31st, 2021. When does he have to recognize the income from this? Right, so this question requires us to remember the rule, right, on the accrual method for prepaid services. Right, since it says he uses his accounting methods to defer income recognition as much as possible, right, on his own books, that means he can defer the service income that he hasn't performed yet. But with service income, you can only defer it into the next tax year. So he starts on December 1st of 2019. So he has to do 1 month of service income in 2019. So that's $500, or between these two answers, right? But he can only defer it into 2020. Right? So even though he performed some of it in 2021, he's going to recognize all the rest in 2020, right? It's our rule for service prepaid income. John and Dawn Johnson are a married couple filing jointly with AGI of 130,000. Their son is a sophomore at a qualified university. They paid $3,000 for his tuition, $600 in fees, $800 in books. Right? And so it's asking what's their American Opportunity Credit. Right? So tuition plus fees, books plus fees. He has $4,400 of qualifying expenses. Well, the American Opportunity Credit is 100% of the first 2,000 plus 1/4 of the next 2,000. Right, so only your first 4,000 of expenses can count towards the American Opportunity Credit, and the maximum that you'll ever get is $2,500. All right, so then there was a bonus question about Kylo Ren. Right, you should have got points for whatever you put. Right, on Blackboard there was a D, all of the above. Most people put that, which is a good answer. Respect for the people who went out on a limb and picked, right, A or B or C. And props to Hunter for clicking everything, which was, for some reason, what Blackboard was looking for. All right, so then we get to the written answers. All right, so the first one, it was, right, a doctor, Mark Sloan. He operates his own business. and he's on the cash method. So during 2019, he received $600,000 in total cash payments from patients. Of that amount, 175 was for services he'd already performed in 2018, and 25,000 was for a surgery that he will perform in January 2020. Right, but because he's on the cash method, he's just going to count all the income he received during 2019. Right, so he's going to start with 600,000. Right, and so there was points lost if you subtracted out the 25,000 and or the 175,000. On July 1st, he prepaid $36,000 to a company that will provide services to his office for the next 9 months. Right, under the 12-month rule exception for prepaid expenses on the cash method, he can deduct the entire $36,000. In November, he agreed to settle a malpractice claim for $80,000. He'll pay the entire liability on January 15th, 2020. Right, so this is what we would call a payment liability, and payment liabilities, right, won't be deducted until they're actually paid. That would be under the cash method or the accrual method. Right, he can't deduct the $80,000 until 2020. During 2019, he paid his staff salaries and wages of $150,000, including paychecks issued on January 1st, 2019 for work they had performed the prior December. Right, but he's on the cash method. He's just going to deduct the amounts that he actually paid. Those are ordinary and necessary business expenses. And he paid his utility costs for the year that he paid were $7,000. So he can deduct the $7,000. So I think minus those deductions, right, you should have gotten 407,000, right, of net, right, business income. All right, so, and most people did good on that one. All right, so Dr. Sloan, right, from same problem here, right, he heard about a new deduction for small businesses. He's a single filer. He takes the standard deduction, and his income is what you calculated in the previous question. How much could he claim as a deduction for qualified business income? Right, the right answer here, right, for full points is $0. Right, because he's in a specified service business, professional service firm. He's a physician, doctor. And his income, right, for a single person, he's fully phased out above 210,700. Right, he's not eligible to claim the QBI deduction. So that was the answer I was looking for. If you just took your business income number from above and multiplied it by 20%, I gave you 2 points. If you knew that it was limited to his taxable income, right, so minus the standard deduction times 20%, I gave you 4 points, right? Even though it's technically wrong, but it's still showing some knowledge. And then I might have gave you 2 to 4 points on that. If you knew, right, in this situation, he actually, right, would be, well, he wouldn't, right, he actually can't claim anything, but if you did the limit to 50% of the wages that he paid, I think I gave you 4 points. Or if you knew what I neglected to even talk about in class is that you have to, right, note for your tax return project, you'll see it on the form, you actually also have to subtract the employer portion of self-employment tax and when you're calculating QBI. So if you did that, I think I gave you 4 points. Next, we asked, what's the policy goal of the earned income credit? I was looking for something, right, like it's an incentive to, it's an incentive, right, to encourage people to work, right? You can put something about it, right? It's to help offset the, right, most people, right, looked in the book or Googled it and found that sentence about it's to offset the effect of payroll taxes, right? And to encourage people to work. That's what I was looking for. You might have lost some points if you just were clearly just putting down everything you knew about the earned income credit or telling me what the earned income credit is, right, and not what its goal is. Yeah, that's what I was looking for there. All right, if you just said something about it's just to help poor people, right, lower income, that's true, right? But there's a lot of different ways they could do that, right? So what's the point of having it increase with income for a certain range, right? It's to provide this incentive for work, right? Is the idea. Okay, so Jack Stewart is an employee of Dr. Sloan's practice. He has a salary from that job, and he also has self-employment income of $50,000. Right, so this one, right, was looking for, the first part is, right, since he's already has 100,000 of employment income, then, right, he only has to pay up to the cap, right, of 132,900. So he's already paid 100 with his other job, which gets counted first. So only another 32,900 of his self-employment income gets multiplied by the, right, Social Security rate. All right, so that's going to be the first part of your answer. The second part is going to be, right, we're going to take 50,000 times 0.9235 to get the self-employment tax base. All right, so there could have been points lost there, and then that's going to be times 0.029, right, the double, right, for Medicare. All right, so the sum of these two is going to get you, let's see, $1,339, or I was definitely very tolerant of different rounding here. All right, so you should have got somewhere close to 5,419. Right, that's the self-employment tax that Jack would owe. All right, so right, most commonly points were missed for not for forgetting the Social Security cap, or forgetting to do the self-employment tax base times 0.9235. Right, or forgetting to double the rates from, right, because you're paying both portions. All right, so, right, I was trying to prompt you here, considering the social self-employment tax calculated above. Jack is a single filer. He paid student loan interest and made a cash contribution to qualified charity. We want to find his AGI. All right, so, right, the main thing, right, I was trying to prompt you to do here, considering this is to take his gross income. All right, and I think I noted on Blackboard, right, it told you what his gross income was in case you didn't look up and see that. Right, so then the main thing to do here is to, right, then he can only deduct half of this, right? So about 2,709. So if we subtract that from his gross income, we'll get AGI of 147,291. All right, is the answer here, right? So you got some points if you, right, if you had the wrong number up here, all right, you didn't get penalized as long as you took half of that and deducted. If you just deducted your full self-employment tax, you got most of the points. All right, this contribution to a qualified charity is deductible, but it's a below the line deduction, so it's not going to affect his AGI, right? So you could have lost a couple points if you deducted that. And the student loan interest, right, if we look at, right, based on his AGI, he's going to be, right, fully phased out. All right, there's a lot of people who still don't know how to calculate these pro rata phase outs and get confused about percentages, right? So let me put right. So for Jack, let's see right, if his AGI is 150, right? Sorry, his modified AGI. So his AGI before student loan interest, right? Which in our case would be 147,291 minus the bottom of the phase out range is 70,000. All right, now divided by 15,000. All right, so people did this and got this number and said, okay, he's phased out by 5%. Right, now this is 515%. Right, so he's fully phased out. Right, once he gets to 70 plus 15, 85,000, he can't deduct student loan interest anymore. Okay, and so if you deducted 4,000, right, I think you lost 4 points. And if you knew that if his income was lower, right, the most you can deduct in a year is 2,500, then I still gave you 2 points. Someone you know wants to donate $4,000 to a qualified charity. They can either donate $4,000 in cash, or they can donate stock they purchased 3 years ago for $1,200 that now worth $4,000. They don't expect the stock price to increase much more. As a tax expert, what advice would you give this person and why? Right. So I was saying, as a tax expert, this is a tax class, so the answer is going to have something to do with tax, not with the price of the stock going up or down. So I was looking for here, right? They'll get the same deduction either way, so that's not going to decide it. Right. If they donate the stock, then right, they get the same deduction, but they only paid $1,200 for it, right? And they avoid the capital gain tax on the appreciation, right? So if you told me something about that or both, right, that they're getting the same deduction for a lower cost and or they're avoiding the capital gains tax, right, the answer was the stock is better for those reasons. Steve is considering donating his personal car, right, and sorry, back up here, ignoring any AGI limitations, right? I still got a lot of people saying, well, cash is 60% and stock is 30%. Right, cash is 60% of your AGI, right? So as long as his AGI, right, even if I didn't explicitly tell you to ignore it, as long as his AGI is more than 4,000 times 60, right? As long as he makes more than $2,400, right, that's not going to be an issue. All right, and besides, right, that's not, it doesn't mean that you can only deduct 60% of every cash donation and 30% of every stock donation, right? That's the cap based on your AGI, right, which you were told to ignore. Steve's considering donating his personal car, a red Ford Mustang, to a qualified charity. He purchased it for $7,000 5 years ago, right? But it's a collectible car. It now is worth 12,000, but the charity is going to sell the car and use the proceeds, right? So this one, most people got this. This was looking for you to say, okay, this is capital gain property, because if he sold it, he'd have a long-term capital gain. But the charity, but it's also tangible personal property, and the charity is not going to use it, right, directly related to their purpose. So he's going to be limited to $7,000, his basis. All right, and some people, right, forgetting, right, about that rule, right, frantically Googling it, right, found, right, the IRS rules for donating cars, right, that say you have to use, right, you're going to be limited to what the charity sells the car for. All right, so my understanding is, right, that's still only if, right, for most people, their car is going to be worth less than what they paid for it. And in that case, people are going to want to inflate the market value. All right, and that's why the IRS has those rules. All right, so my understanding is in this case where the car has increased in value, right, we're going to be limited to basis. Those rules, right, for capital gain property take precedence. All right, but if you could prove to me that even with capital gain property, you're going to be limited to where you're going to use what the charity sells it for. If you're able to prove that to me, let me know and I would give you points for that, right? But the right answer we're looking for here is 7,000. Right, and proof, sending me, right, the IRS publication about the rules for cars, right, a donor's guide to donating your vehicle or your car, right, that's not going to be proof, right? I'm talking about proof in the tax code or regulations, because my understanding is the answer will be 7,000. All right, so that's the test. Overall, right, people definitely did better than people usually do on this midterm, which, right, makes sense because it was open book and you had more time. But right, people performed up to what I thought, and so I'm definitely happy with how people did. Good job, keep going. Right, so the right thing, you head to the final, right, some people got in trouble, right, where I can see tests where people did very good on the multiple choice, right, and then they kind of bombed the written questions, which, right, shows me people were spending too much time, right, not prepared enough in advance, that they had to spend a lot of time looking up the answer on all the multiple choice questions, and then they ran out of time at the end, right? So it being open book gives you this temptation to not study, then you're going to run out of time. My advice would be to prepare for it as if it's not going to be open book, as if maybe I'll have one sheet of notes, all right, but then luckily on the day of it gets to be open book. But prepare for it as if it's not. All right, but the format of the final at this point it will be very similar. It'll be a little bit longer than this test, but you'll also have more time. You'll be able to use your book and notes. All right, I know the people who always sit together in class, right? If you're those people and you turn in your exam right around the same time, I can see that and I can tell if you have very similar answers. Please don't do that, right? You could lose a lot of points. All right, so, right, but that's a review of the exam, right? None of this material is going to be on the final, right? But just as a review for a lot of people asking about, right, wondering if they got the answers right, and all that, right? Let me know if you have other specific questions.